All right, welcome back to Two Super Guys Trade Stocks. I'm Vinny,
I'm Dylan.
and this week we're going to talk about the old stock market adage: "Sell in May and go away." Like, what is that based on? Where does that come from? And like, should you actually adhere to that? If you guys are new here, we at Two Stupid Guys Trade Stocks are all about entertaining, educational stock market investing kind of videos. So you can, by all means, like and subscribe below if you enjoy this kind of content. So
Yes, please.
yeah, please. We enjoy the company, rather than Dylan and I just yelling at each other. So I don't know if you knew this, Dylan, but this is actually where it comes from. It's sell in May and go away and come back on St. Leger's Day. St. Leger's Day is the first of the British Triple Crown events, kind of like, we have our Kentucky Derby. That's the British equivalent. And it was traditionally in mid-September, September 15th. So a lot of bankers and kind of the investor class would typically leave London and go out out to their country home for the summer, and then they would come back around mid-September in order to be there for this race.
So this race causes all the strife, or used to cause all the strife in the stock market for years and years and years.
Well, I mean that it was just kind of like people would take the summer off. The American equivalent is right. This Dylan and I are shooting this Memorial Day weekend, and Memorial Day is kind of like the beginning of the summer for Americans, and then Labor Day is kind of like the end of the summer for Americans. Not by kind of calendar date per se, but like just kind of how people act. I guess you could think of it that way. So there's actually some truth to this whole backstory about whether or not you should just sell in May and go away. Historically, it depends on which time period you're looking at. It gets a little bit complicated on S&P 500 versus like Dow Jones, because S&P 500 didn't exist until 1957, that sort of stuff. But you're looking at an average return of just 0.3% for that period of May to October from 1950 to 2013, which is quite a long period of time, right? Like,
yeah, that's a solid statistic. That's actually very surprising.
yeah, and then look at the other half of the year, 7.5% during the other half of the year. So I mean, you're talking about drastically different returns depending on which 6 months of the year you're talking about. There's a great chart coming up here in a couple slides that really illustrates this point visually. But if you notice, they cut this off at 2013. That's one of the interesting points, is that since 2013, it hasn't quite been that story. It's different. People are different these days. We have access to a lot more technology right in our pocket. You can be trading stocks from the beach now, right?
Right.
If you're in Arizona like Dylan, he doesn't know what a beach is, but still from the cactus farm, I guess.
I miss the ocean so much.
Yeah. So there was another study here. This is by Ned Davis, where they looked at what would happen if you invested $1,000 into the S&P. At 1950, it was S&P 90 at that point, and then either had it in from the May to September period versus the having it like in and during the summer months as well, or just the summer months. And look at the difference in return here: $75,000. Granted, this is over 62 years, okay? But your $1,000 would have gone into $75,000 if you followed the adage of sell in May and buy back in October.
That is absolutely insane. Versus $1,032.
Yep, exactly. Yeah. So this old adage actually does have some truth, at least for kind of mid 20th century United States stock market, right? Not.
That's gonna be like our stim check scores.
Yeah.
Our stim check accounts after 1 year.
Yeah, maybe one of us will have $1,000. I want to have 75,000.
That's my goal.
Yeah. If you guys aren't following around along with our stim check challenge videos, you should check them out. Dylan and I are competing with a $1,400 starting balance to see who can grow it most in the first year. Dylan's ahead now, so now he's all excited about the whole challenge. So this is that other chart I was talking about. Look how drastic this is when you pick like a rolling 6 month kind of return period, and categorize or rate them by what the average return percentage was. So that November to April time period, 7%. Compare that all the way to this May to October, 1.5%. But I mind you, this is still a positive number. You still gained 1.5%. And if you look at this other column here on the right hand side, it was still positive 64% of the time. So only 1 in 3 times was that 6-month period of May to October negative.
Right.
It still grew, but just not as much as other times of the year. And now, I was talking about how there's a question of whether or not this is truly applicable today, this traditional thought of sell in May and go away, right? So up till about 2013 here, you're looking and you see positive 10%, positive 7%. This one's basically flat, negative 0.3, positive 3, positive 8, positive 2.4, 3.1, and then 7.67. I had to do the math for last year. But you're looking at more consistent kind of positive returns here over the summer months, and you're looking at some pretty sizable returns. I mean, if you made 10 or even 7.5% or 8% for a whole year, like
that's
bad.
Great.
That's approximately what the S&P 500 returns historically. So you'd be missing out on quite a bit. I want to say even more specifically, they talked about, I think the NASDAQ in, I can't remember if it was 2017 or 2018. But if you had followed that advice with the NASDAQ that year, you would have lost out on like half the gains basically for the year.
Yeah, the NASDAQ went absolutely insane in 2020.
Yeah, like during the summer, too, specifically. So, one of the things that kind of contributes to this whole sell in May and go away thing is this October effect. There's been a few really famous historical events in the stock market that have happened in the month of October. These are the kind of the top 3 here that I mentioned: the Panic of 1907, Black Tuesday 1929, and then Black Monday 1987. I guess they just love naming things that way.
Yeah, I don't know.
Yeah, I know. What about Black Wednesday? Maybe
it's coming. It's just not here yet.
So I sort of throw up some graphs of that. These 3 historical events here. So you have the Panic of 1907. Pretty dramatic little pullback there, but market bounce right back. But this was in October, so you're kind of seeing this time period where you're going to get this rebound, and you're going to see that within that kind of November to April time period, right? Same thing here. This is Black Tuesday. You ever seen this graph before, Dylan?
Yeah, I have, because this took a little bit longer of a time to recover than.
Yes. This section,
COVID was like a V recovery. Like we just came right back up.
Yeah. This is actually 1987. Sorry. This is Black Monday. But yeah, the really dramatic. One of the things that's kind of really blamed for this is kind of stop losses and automatic trading there. So there was computer algorithm in the infancy, right? As you can imagine, computers in the 1980s were not exactly the most sophisticated things in the world. So it kind of saw like a sell-off, and that triggered a whole wave of additional selling.
Oh boy.
Yeah. This is another graph from that same day, that Black Monday 1987. I mean, that's a scary little graph there. That's for sure.
That's a rough day. It's not a good day.
Yeah, exactly.
Imagine if you were retiring in November of 1987 and then that happened.
Yeah. That I don't even want to begin to think about that. That's crazy.
I guess everyone had pensions back then, right?
True. Yeah. And, it's funny, as like an American investor, we're often really focused on all the data I just kind of talked about from the Dow Jones and the S&P 500 or S&P 90. I found this interesting website here that actually goes through the global indices and looks at the same thing, where they break up the year into 2 different time periods. Winter months and then summer months. That cartoon is kind of funny too, but and then they also show you the whole year return. And basically, if you're invested in the summer months, it was basically flat for most of these countries, and the winter months actually outperformed the overall year. Yeah.
Right. So these are the ones. These are the Oh, these ones lost money. Okay, I get it.
Yeah, exactly. Yeah, but
what's going on here?
Yeah, so you see the summer months down there in the bottom in the red. You see winter months up top in the green, and then you're also seeing the overall yearly returns in that blue line. So if you're kind of look at that, you can quickly kind of tell that winter outperforms the average basically, and that summer contributes very little, and if anything, it might actually detract slightly from the overall market return. That's the Canadian stock market index. Chinese, kind of same thought process there.
Yeah, it actually looks like it's lost. in the summer.
Yeah. France. Yeah, that's DAX is German. Yeah, there's the DAX. Same thing. Look at the outperformance of the DAX, and then same thing with the Nikkei. Really dramatic how much you're seeing additional gains if you're just held for that 6 month of the winter compared to including the summer in your yearly returns basically. So it's kind of crazy.
Oof, this one's pretty wild.
Yeah, I know. It's mirrored widely throughout the entire world, which is interesting to me at least.
Yeah,
and of course that's
USA.
Yeah, the USA. You want to go back up to that cartoon? I just think it's kind of funny how they're like, yeah, we're just gonna go ahead and avoid all these problems.
Yeah,
inflation monster.
Yeah, that's pretty good.
Yeah,
I like the social media bubble, how they added that one in there.
Well, this is from like 2017, I think, too. So this is actually it's funny that it's still very accurate.
If anything, it's more accurate now.
Yeah, the weekend in dollar and inflation are topics that are like super pertinent right now with investors.
Oh yeah, isn't there another one? I like this too.
Yeah, the Mark Twain quote.
Conclusion: sell in May works. October is one of the most dangerous months. The others are all the other months.
Exactly. Yeah. If you really wanted to be completely safe with your money, you should probably be digging a hole in the ground and burying it. But the reason why you get the market is to make a little bit of money, so you have to assume some level of risk. But yeah, I just thought it was kind of interesting to see that this adage does have some truth to it, but it's not been quite as predictable since 2013 or so. Like I said, the ability of people to trade stocks from anywhere, right? Like I trade stocks in the hallway between patients at work sometimes. So.
Yeah, so do I. That's where I got those Palantir calls.
Yeah,
So one thing that is interesting about that is because we have all this new technology, like you said, you just trade stocks. That wasn't a thing 20 years ago. Like that, it wasn't. There wasn't apps on your phone that were sophisticated enough to do that. It's interesting that we're seeing a wave away from the summer tradition, but there's also like a self-fulfilling prophecy here. For instance, that's how like day trading works, right? So my swing trades, when we do those for the swing video, one of my favorite strategies is bouncing off the 200 SMA. Mm-hmm. The 200 SMA is a level that just everyone is looking at. So when it hits, everyone's like, all right, we'll buy it. And thus, even if the stock deserves to come up, it'll go up a little bit at least, unless it has too much pressure. So you have to wonder what weighs heavier, the new technology and new ease of investing versus 50 years of research saying this is a bad idea.
Yeah, true. I know it's a real debate, I guess you could say there, about which one matters more.
I'm going to invest more in the summer.
Yeah.
Yeah.
Solid plan.
I mean, I didn't really know this, and I already have probably 10 calls expiring in October. So I'm hoping those gains get there.
Oh boy. Look out for Dylan on Black Wednesday this October.
Yeah.
All right, guys. Well, thanks for tuning in. We'll catch you on the next one.
Have a good one.